There's nothing left to do but to identify the optimum moments to buy or to sell. A mere trifle. This trifle has tantalized traders over the centuries, and a whole science has developed called technical analysis. The Western School of Technical Analysis has its roots in 19th century America. I describe technical analysis as a science. What do I mean by this? Well, one thing I mean is that it's governed by clear and rigid laws. New change in price is charted by a standard move across the chart. The chart takes no account of time, so the more times the price changes in, say, a minute, the more moves are made across the chart. Hello people, you'll find the material discussed in today's film much easier to digest if you run through it using our charting software, Rumus. In Chart Analysis 1, we looked at support, resistance, trend lines, channel lines, and we explored what a trend really is. We described technical analysis as a science, and we looked at the theory behind it. In this film, we're going to view chart analysis as a subjective skill. We're going to focus on the art in charting. I'm going to take you inside the trader's chart room and look at a selection of chart patterns that crop up time after time. Generations of traders have used these patterns to identify future price movement. These patterns can help you make money. Just a word from the wise though, never underestimate the market. Countless people have spent their lives trying to find a surefire pattern that allows them to predict the market with 100% accuracy. Only very few succeeded, and those that did have only been right for a short period of time, and then the mood of the market moved on, leaving their elaborate systems useless. The fact is though, that the patterns we're going to be looking at today are accepted as the most reliable patterns, and many traders act on their signals. In some ways, what we're doing is exploiting a self-fulfilling prophecy. What we need to do is see what the other players are seeing and learn to read these patterns in order to take the next step. Make sure that you work with patterns that are easy to spot. Just remember that the more traders that can see the pattern, the more predictive that pattern will be. These patterns are traditionally split into two camps: the continuation patterns, which signal that the current trend is going to continue, and the reversal patterns, which signal that the current trend is about to reverse. Let's start off by looking at some signs of reversal. This simple pattern is known as a reversal day. You can find it either at the top or the bottom of the market. Now, it stands to reason that the basic requirement of any reversal pattern is a prior trend. Therefore, the first thing to remember is that each and every reversal pattern needs an uptrend or a downtrend to reverse. This trend can be a major, an intermediate, or a minor trend. And all we need is a trend of some degree. The reversal day follows a typical pattern. On a bull market, it is preceded by a sharp price rise, and the pivotal day sees a bar with the highest maximum and with a closing price lower than the low of the previous bar. So the bar of the reversal completely covers the bar of the preceding day, as you can see here. This pattern crops up pretty frequently on charts, most usually on minor trends. Why minor trends in particular? Simply because sudden price changes are short-term in character. So what should we do if we spot a reversal day? First of all, we should fix our profit. Close any position you have on the preceding trend. It's better to be safe than sorry. And at the bottom of the market, the advice stays the same. Cover yourself, fix your profit. Sometimes the reversal takes place over 2 days, and we call this a 2-day reversal. On an uptrend, prices on the day are rising and achieve a new maximum. Prices close at a point very near to the day's high. The next day sees price closing at the low of the day before, or even lower than it. One point to note is that the wider the price range over the 2 days, the more power the reversal has. The significance of the reversal, whether it's a 1-day or a 2-day, relies heavily on where and when it occurred on the market. You've got to look at the bigger picture. If the market has risen or fallen sharply without any intermediate corrections, or has neared long-established resistance or support levels, then the reversal signal deserves your attention. Sometimes reversals happen as part of a larger and more significant chart pattern. We shall explore these larger chart patterns further. When this happens, the reversal tips us the wink that a more significant pattern is on its way. You know, pretty often, a reversal of a short-term trend happens near a long-term support or resistance trend line. Although we call these patterns 1-day or 2-day reversals, the pattern can be found on charts of any time period. Please bear in mind that the longer the time period, the more significant the reversal. I'm not suggesting that you trade only on monthly charts. What I'm saying is, gauge the value of this pattern with the longer term trend in mind. And if you're looking at a monthly chart and you happen to notice a day reversal pattern on it, then it can give you an idea of the direction of the trend for the next 3 or 4 months or so. And that is going to help you in your daily and intraday work. The next pattern from the chart room that I'd like to take a look at is based on 3 trend lines. It's called the fan principle reversal, and it's an alternative way of using trend lines. You know how when there's a down trend line breakout, price often falls back a little, retesting the old trend line, which is now a support line, and price fails to break through it. So what you do here is plot a new resistance line, which price breaks through too, and then falls back, giving us a new support. You plot a third resistance line, and when price breaks out of this, it usually signals the beginning of a new uptrend. At the top of the market, the breakout of the third fan line signals the beginning of a downtrend. It comes as no surprise that this is called the fan reversal, because the 3 trend lines look like an open fan. The main thing to remember is that breakout on the third line is a strong signal of trend reversal. Sticking with the theme of trend lines, here's a technique which combines support and resistance lines with correction levels.
What you've got here are your speed lines.
Cast your minds back to our bit on correction levels in the last film. Do you remember? To plot correction levels, we draw a perpendicular from the trend minimum to the level of the beginning of the movement. We measure off 3 points on this line at 0.382, 0.5 and 0.618. We then plot lines from the beginning of the movement through the correction points. These lines are sometimes known as projected trend lines because before the correction occurs, the lines hang in the air, but once the correction begins, these lines delineate levels of support and resistance. Play around with it on Rumus and you'll see. Here they map out new lines of support and resistance on a correction of an 8-month downtrend of the euro in 2005.
You can use speed lines on any time horizon. Just remember, the longer the time period, the stronger the punch and the more potent the reversal.
Here's a fan I plotted on the Aussie way back in 2002. The lines of the fan continue to give useful information to this day.
These lines have a wealth of applications which we'll explore in our film on wave analysis. This pattern is called head and shoulders. It's not to be confused with a medicated shampoo, I might add.
The pattern is a great favourite with traders and was identified way before the appearance of the shampoo. Why they called it head and shoulders is obvious. The large peak in the middle is the head, while the two flanking peaks are the shoulders.
It's not only a very important pattern in its own right, it's also the key to the other reversal patterns. If you can work well with head and shoulders, you'll easily cope with the rest.
In fact, most of the other reversal patterns are mere variations of head and shoulders and therefore will not need an in-depth explanation. The reversal patterns reflect the play of forces that produce trends on the market. Remember the three groups of traders in the story in Chart Analysis 1?
In our first film on chart analysis, we saw how useful it was to plot lines on our charts. Lines like support and resistance, channel lines and trend lines. We'll continue with this now that we're dealing with patterns.
Learning to plot these lines will significantly improve the returns on our trading. Let's consider what's happening on the market while head and shoulders is forming. We start off with an existing uptrend, that is consistently rising maximums and minimums. Price then decelerates and falters, just as we saw with the fan reversal, and the trend flattens. At this moment, the forces of supply and demand are in balance. At the end of this phase, price breaks through the flatter support and a new trend, a downtrend, begins. This support line is known as the neckline. Sometimes the neckline can be plotted immediately after the left shoulder has taken shape, but usually we need to see the head before we can plot the neckline with confidence. More often than not, the right shoulder is similar in appearance to the left.
This repetition of shape and patterns is the key to chart analysis. It enables us to use price history to understand its likely future.